The good old pop and drop. What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. Is the stock market starting to now digest after today's price action? Well, we're going to look at some charts. We're going to look at some volume. We're going to go over predicted ranges. We're going to go over expected moves. We got a lot to talk about on today's episode. Before we hop into it, if you have not heard about my Patreon community, it is $9 a month. Now, keep in mind, Patreon, they charge on the first of every month. So if you buy, in the middle of the month, you're charged again on the first of the month. You can avoid that by paying annually. You get a 16% discount, so it ends up being $90 US. That's where you can get all of these benefits over here, swing trade setup ideas that I post in my trade ideas section, which is all on Discord. So once you get this, you got to get Discord and sync them. I give my weekly expected moves that track about 40 products. I give zones, which is not listed on here because I'm still testing it. So you can go there and see the daily zones, which I typically show here on occasion. Not going to show that today because we talked about that one yesterday. And yes, you get access to the private Discord channels, the community, and all that good stuff too as well. Let's go ahead and get into today's episode. So should this be the start of potential reversal digestion in the markets? What I want you to pay close attention to is how the candle formed, where it formed, and then the amount of volume, okay? And that's how we can kind of gauge, is this, the start of something, or is this just a hiccup into Friday, okay? First and foremost, I want to look at the mega cap stocks. So we're going to start here at Microsoft. The candle, right? It is a bearish engulfing candle. Where did it happen at? It happened right at the weekly expected move. Okay, so right at the upper edge, if you were ready, right, a lot of people, look at this and they're like, oh, they don't matter this time around, or they matter this. This is based off of implied volatility. This is not what I expect. This is what the options market is predicting as far as risk goes on a weekly basis. And you can see it came up to 290 and it will retrace from that level. Doesn't mean that it always acts as resistance, so don't get that in your head where you have to short it here, but there are some good techniques that you can use intraday. Needless to say, we hit the upper expected move, we reverse, and that is a bearish type of candlestick formation. It has not got a confirmation break to the downside and filled this gap, or, there's just still a lot going on, so it's very early stages. However, the volume today, very lackluster, right? So on a day of selling, pretty aggressive looking type of day, how it kind of ramped up, and then we sold off, the volume was pretty lackluster, okay? Now, if this was a big old volume bar, we can consider this distribution. Now, this is also happening right beneath the 200-day moving average on the Microsoft, which is rather neutral or flat. So I want you to take that into consideration going into the rest of the charts because I'm not going to spend that much time on each individual one. But let's look at Google now. Google, take a look, weekly expected move, tagged it, bearish looking candle. You can call that potentially a bearish engulfing. Maybe a dark cloud coverage would be more accurate. Needless to say, little pretty bearish, and it's on lackluster volume so far. So nothing out of the ordinary really here at this particular point in time. If you just look back to the left of the chart, though, it is in this area where there is prior resistance. Then you match that with the weekly expected move, and we're below the 200-day moving average still. So on a good note, even if we pull back to the lower range, it's still above the 20 and the 50, which is sloping up. So will we see that happen? I don't know, but at least consider the low volume, the bearish candle, and see what takes place then. If tomorrow we get a big bearish day on a Friday, right? Who knows what can happen? But then all of a sudden we get increased volume, that could signal some type of distribution. And we just have not seen that really at this particular point in time. If we take a look at Apple, very same situation, dark cloud coverage, bearish looking candle. RSI's, in the overbought territory, but also that represents strength too. We don't see any negative divergence building at this particular point in time, but it came up to the weekly expected move, got that dark cloud coverage, closed almost at the low of the day, and look at the volume. The volume is lackluster, all right, for selling volume. And then on this move up, you can see that the histogram on the MACD is starting to decelerate, which that is building out a negative divergence. Tesla, also very similar situation. This was, this is a little bit hard to gauge, but yes, decelerating volume, and this could very well be potentially flagging. So I want to take that as far as the bullish note goes. This is happening over, just under, a neutral 200-day moving average. We got above that weekly expected move very slightly, and we've been just kind of trading within the middle of the weekly expected move. So not much action, just a lot of chop back and forth. We'll see here if this does want to turn into this being digestion. It comes into the 20-day. or we get some sort of fake out to the 50-day and it holds as support. But we'll see here if that is potentially forming a bullish pattern where we get a breakout, and that thing could potentially, scream higher, as we've seen many gamma squeezes in Tesla chart, okay? So overall, the absolute value, candlesticks, right? Price action, price pays, looks bearish so far, but we're just tagging the upper weekly expected move. We're not beneath it. We're not above it. It's pretty natural, pretty normal so far, okay? Now, this is another chart that I've been sharing on occasion, and I want to revisit this. We have that rising wedge. This is on the Qs. Now, it says IWF over IWD. That line is actually invisible behind this chart. And the reason why I'm measuring and mapping that is because I have the rate of change beneath us. Okay, the rate of change of the relative strength between growth and value has indicated where we can see some potential weakness in the Qs, okay? So what does that mean? It means that when the rate of change between growth and value cross down through zero, we have seen some weakness or periods of digestion in this market, okay? And we pointed this out before right here where it looked like it was about to cross under, but guess what? It didn't. Now, when it crossed above, guess what happened, right? We bounced up, we moved, and we started rocketing. So this goes the same way. If we start, breaking to the upside, it can signal big moves that are strong within the tech sector or growth sector as well. But as it stands now, we are turning back down. We're still above zero. So that is a positive sign. But, if it starts closing beneath there, we could potentially, let our foot off the gas, make sure you're not FOMOing because it could be a period of digestion or potentially something bigger. We don't know that, but at least this will signal something to us. Another thing that I want to pay attention to is this negative divergence on the BP NDX, right? We had a high, lower high, we had a high and a higher high, has not played out of any sort, and we're not overextended to the downside or the upside right now. So it's kind of a lackluster negative divergence, at least as it stands right now. If we go to the BPCOMPQ, this one is in that overbought territory for quite some time, 82.19 reading, and this one is just now putting in a negative divergence where we have a high to a higher high, but the internals are a high to a lower high right there. So we'll see here if that will signal a potential pullback at some point. Remember, these don't just stay up here forever. They oscillate, right? They go up and then they come down. They go, up, they go down, up, down, up, down, and a down, up. That's what they do. So right now we're up. So this means just be cautious, be well aware that if you're FOMOing into this and all of a sudden we get a pullback, it's to be kind of expected. All right, let's go to BPSPX chart, also in that overbought territory, and we have a negative divergence there. If we take a look at the Nasdaq McClellan oscillator, right, price is continuing to wedge, and we have a negative divergence there. Very similar on the flip side, we had a bullish divergence forming right here with that falling wedge, right, as the bottom was forming up in here, and then we saw that pop outside of it. If we continue on a broader market, we look at the New York Stock Exchange oscillator, also very similar, same situation, right? We had some nice breath here, some nice breath here. However, then we started to get weakening breath as the market perpetuated itself higher, and that indicated that we could very well see the market pull back or digest. Doesn't mean that it's going to go pow to the downside, but it can just be a period of digestion until it works itself out. How did the market perform today? If we take a look at the 11 sectors, energy, financials were the leading sectors, and we'll talk about why that is and also why technology and consumer discretionary were there towards the bottom. But overall, the Dow Jones relatively flat, S&P 500 relatively flat, small caps, were up slightly, but relatively flat across the board. Talk about a stop rate out of the gates. It was this huge rip up to the upside, probably sucked in so much FOMO, or stopping out shorts, and then all of a sudden it completely reversed and fell flat on its face. So for a rather flat day, it was quite eventful. So why is this look the way it does? Well, the 10-year yield is a little bit of a, insight look into why those sectors perform. Now, when the 10-year yield is rising, these typically like to rise too. Financials and definitely energy has a stronger correlation. You can see the energy or financials is a little bit broken, but if you do take a look at just XLF by itself, it does like a rising yield. However, we've been in this kind of inverted territory, kind of back and forth, which is sending things a little bit askew. But you can see here, as the 10-year yield rise these last couple of weeks, well, we're getting a pop there. And then also right here, we started moving up higher, and you can see the uptick there in the relative strength line between XLE and energy. Now, on the flip side of that, if the 10-year yield is rising, what happens to XLK and XLY? Well, as it's been going down, this has been rising. But as soon as this started picking up today, well, we started seeing it pull back to flatten out. As to be expected, we've been discussing that on this market brief show. If we take a look at what happened to the yield curve, came up slightly today. It's still negative 36 basis points in inversion. The 10-month, 3-month came up a little bit as well. Still, it's at 25 basis points, not too far away from inversion. We'll continue to monitor that, see what develops. If you take a look here at TLT, TLT came off hard and fast, following through on this weekly candle. So we'll see how it closes. On the flip side of this, if we take a look at the daily time frame, not the weekly, and we look at the expected moves, it is coming down to that lower edge of the weekly expected move. So if you are, a cycle type investor and you believe that bonds are going to be a place to be, these are the areas where you start to think tactically, but you don't just go all in, right? You start slowly building into a position that'll allow you for example, if you were to build in right here, 50 basis points of a position. I know that's very conservative, but that's just how I trade. So I'm going to just share with you that. Okay. And by the way, this could be breaking down from a bear flag. But yeah, 50 basis points here. And then all of a sudden the weekly expected move, the lower end next week is, something down here or something. Well, then I'd add another 50 basis points if it came here. So my average position would be still right there. And then if we are right about the cycle where bonds start to pick up here, in the later stages or in the following quarters, you're building slowly into a position to potentially catch a move higher as time progresses. That is just one way to consider it. Another thing to consider is I do publish those zones, and on the TNX, the zone actually, as of right now, and these are dynamic, it's right here at just under 29.5, which is 2.95 on the 10-year. And then the low end is down here beneath 26.5, or I'll just call it 2.65%. So if it comes up here, this could signal, right, as that comes to the upper area, it could signal a potential also area to where we can get into bond positions. And it doesn't need to be TLT. It could be other, there's IEF, there's BAB, there's I think it's EDV. There's all kinds of different, ways you can go about it. But hopefully that gives some insight into it. We're going to hop in now into the SPY chart, and we're going to do very similar to what we did at the beginning, looking at Microsoft and all those big techs. So let's look at the candle first. Candle, not too hot looking. It finished, the SPY finished, I guess, flat on the day, decelerating volume. So it got outside of its weekly expected move and then started closing more towards the low end. So yeah, no volume that's really all too scary right here. And there's nothing too unexpected going on, right? We had this big pump out of the gates, and then it fell on its face. Let's take a look here at the 65-minute time frame. You can see we're talking about this broadening wedge, and this is where typically you get a little bit more increased volatility, which we've been seeing. It popped out of the gates, right? You can see here, popped out of the gates, right? Look where it gapped open. Okay, so it gapped open right over the expected move for the week, came down, touched it, right? And then started shooting up before it started selling back off to close its daily gap. Okay, so we're still above an inclining 5-day moving average at this particular point in time. Bearish candle, but not bearish volume really. It doesn't show signs of distribution at this particular point in time. If we take a look at the Qs has a bearish engulfing candle, right? The body is engulfing the prior one, so that's pretty bearish. Volume, pretty lackluster, so nothing to be overly too scared about. But if we get follow through, start looking for the gap to get closed beneath us. That may or may not happen tomorrow. I'm not expecting all too much craziness to happen tomorrow. We do have consumer sentiment survey coming out. I don't know if that's going to affect the markets all too much, but we'll see here what consumer sentiment does. Hey, who knows if there's a huge, all of a sudden, uptick on consumer sentiment and everyone's doing super well, maybe the market will rally. Let's go ahead and continue on. I guess actually one more thing to note, as the market's been perpetuating to the upside, the histogram is dying off a little bit, so momentum could be just kind of slowing down here, where we could be going into that consolidation phase, and we're still beneath that 200-day moving average. If you take a look at the 15-minute 15-minute time frame, you can see here megaphone pattern, right? Volatility is increasing. This is how diamond patterns, diamond topping patterns, diamond bottoming patterns are formed, right? Price is tight, then it starts wildly going everywhere, and then it starts contracting back again, and then it forms, something like that, right? Contraction leads to expansion. Expansion can lead to a contraction, so we'll continue to monitor, see what develops here. As it stands right now, bulls have the short-term, control still at this particular point, right? Price is going up, 5-day moving average is going up, and price is still above that. If we take a look at the IWM, this one's more interesting. I find this actually more to be a good risk to reward trade. Notice here it tagged actually the 200-day moving average, Okay, it reversed flat on its face, closed at the low of the day. That is a shooting star candle. It is outside of the weekly expected move. Okay, and then we also saw some increase in volume. Nothing too wild and crazy, but that right there says, hey, if we start getting back within here, this could be a good potential short opportunity with the tight risk to reward. So that is one thing to obviously pay attention to, right? There's been a massive squeeze in small cap stocks. And, if you missed the first fall or second fall, it's giving you another opportunity is basically what this did, as many, many high short interest stocks just continue to get just squeeze like crazy. If you take a look at the 65-minute time frame, you're still technically, if you're very conservative and patient, you would wait for price to get back under a 5-day moving average, start having it flatten out to declining, and that's how you would trade it. Versus trying to fade the move into a 5-day moving average. Your risk to reward right there would be a 1-for-1 for the most part if you just entered in on open and it came to tag the 5-day moving average and then you just covered right there. It's a possibility to trade that. I'll let whoever the trader is come to that distinction. As it stands right now, price has been ripping up. Momentum has been falling flat on its face though. Right here, you can see it's not, it's diverging while price is moving higher. But we're still above those 5-day moving averages, okay? Now, I want to get into Bitcoin before I go into some predicted ranges here. So if we look at the chart of Bitcoin, let me center that. This is the Saylor to Schiff tool. The Saylor to Schiff tool is still on an active buy signal since early July, and you can see the price has been moving up. Nothing too crazy and aggressive like it was over here. Woohoo! So we'll continue to monitor, see what develops. As soon as we get that sell signal, I will let you know, but it still remains on a buy signal. I will note on the daily time frame, we have this wedge forming, very similar to like, over here we had one. This was somewhat similar where we had a bull trap and then it sold off. If we get a little bit more hype, watch for a potential bull trap, especially if we get a bull trap and then the indicator goes to a sell signal. But as it stands right now, we are just putting in some short-term higher highs and higher lows. But price is also, from a big move to the downside, right? Expansion leads to contraction. Price is tightening up. So it's likely to see some sort of a big move in the near future. Let's go ahead and take a look at these predicted ranges. We're going to start off with a SPY. Okay, so yesterday, this gray box, and this is based off of average true range. There's a calculation behind it. I got that calculation from Buddy Carter, which I don't even know if you can even... besides the point, I'm going to share it some other day. Okay, so what this is right here, this was yesterday's, right? We predicted a higher high and higher low. So the candle, right? The red, that's the candle. The gray was the prediction. We got that higher high and we got that higher low. Price finished within, it closed within the range, which is to be expected. This next candle, it is predicting a lower high and a lower low. So that would be the range that we're looking to potentially be at tomorrow. And these type of ranges, right? And notice how also there's a year-to-date VWAP. We talked about that, right? It came into it, held as resistance, got a little bit above it, but then closed back within this range. So chances are price can very well close within this range, and then you can create trade plans around it, like, hey, I'll short if it comes back up into this range, right? And then I'll have a stop loss below or just above the high of this candle. And if I'm stopped out, well, whatever. It's a good risk to reward, especially if it continues to the downside. You got to determine how you want to play, or if you want to play the long side, right? You might okay, maybe I might buy right down here, if price gets down here, and that might be a good entry point, or I can start a position here. And if it, the next predicted range is down here, right by this gap, maybe I'll add into that position. There's so many different ways you can play it, but you just got to focus on risk first. So that's the range going into tomorrow. If we take a look at the Qs, it is also putting in a lower high and lower low. Pretty large range overall, though, from 321 to a 327. And this was yesterday's range. You can see the candle closed just perfectly right within it. Doesn't do this 100% of the time, but it gives you an idea as to where to potentially see the market move based off of historic volatility. That's what ATR is. The average true range is historical volatility, and that's why we look at historical volatility, and we also look at implied volatility, i.e. expected moves, right? Because it gives you the future volatility being priced in, and then we look at what historical volatility is. And if that doesn't make any sense to you, well, stick around long enough and you will eventually catch on to it. This is the IWM. Expected move for tomorrow is also a lower high and a lower low, pretty large range. This candle got way outside of it, as you can see, but we ended up closing back within that expected move range. Expected range, not expected move, just the other day. That's all I got for you on today's episode, everybody. Hope it helped out. See you later.